promise with my student, today we are starting a new series of lectures on financial statement analysis. Financial statement analysis, as you know, is very important course for the business student. Being a business doctor, a student should know the connections of the financial statement, the connections of the income statement with the balance sheets and other financial statement. I am Dr. Safdar Tahir, postdoc UWA Business School, the University of Western Australia, Associate Professor, Lalpur Business School, Government College, University, Faisalabad. Today we are starting this analysis with the first ratio, which is called the leverage ratio. The word lever is very important and it is connected with the borrowed money, as lever is working on the borrowed force of others. The Greek philosopher Smith said, "Give me a lever long enough and a fulcrum on which to place it, and I shall move the world." Certainly, this is a force that the lever gives you, and by which you can move the words and you can run your business. In financial leverage is an investment strategy of using borrowed money and especially the use of various financial instruments or borrowed capital to increase the potential returns of the investment. And we have a different leverage ratio. The first one is total debt to equity ratio, then long term debt to equity ratio, total debt to total asset, long term debt to total assets, long term debt to total capitalization, long term debt to capital assets. These are the important ratios in this leverage ratios. Look at the balance sheet. We have a five big component of the balance sheet. Current asset, which is called a working capital, capital assets, which is also called the fixed assets. And the other side, the right side of the balance sheet, we have a current liabilities, long-term liabilities, and owner equity. Students should note that there are five big components of the balance sheet. And the first one is the leverage ratio. Leverage ratio is starting with the leverage ratio, that is the total liability divided by owner's equity. Current liabilities plus long term liabilities. This is the first ratio. And the second ratio is long term liabilities divided by owner equity. Then there is a question which ratio we should use. Either we should use our total assets or we should use our long-term assets. Certainly, if we want a comprehensive overview of the company, we should use our total assets. And if we want to analyze the financial structure and solvency, especially for the credit worthiness assessment, we should use a long-term debt. Debt to equity ratio is this. For Basket Wonder, December 31st, 2023, this ratio is 0.9. It shows the extent to which the firm is financed by debt. And we can compare this ratio with the industry average. We see that in 2021, this ratio of BW is 0.81, industry ratio 0.89. In 22, this ratio becomes 0.88 and industry ratio 0.9, and in 2023 this ratio is 0.9 while the industry ratio is also 0.9. So we can get the insight BW increase its average debt utilization relative to the industry average. So the risk of BW is increasing. The third ratio of this is the total debt to total assets, and the fourth one is long-term debt to total assets. We can easily calculate this ratio by these formulas. Total debt to total asset give you insight that the percentage of the firm's assets that are supported by the debt financing, and for BW it is 0.47. We also can compare this ratio with the industry. BW has an average debt utilization relative to the industry average. And other segment of this ratio is a long-term debt to total capitalization and long-term debt to capital assets. Long-term debt to total capitalization is equal to long-term debt plus equity. And this ratio shows the relative importance of long-term debt to the long-term financing of the firm. It is 0.32 and it is a 0.32 for BW and industry average is 0.3. So BW has an average long-term debt utilization relative to the industry average. Who are interested more in leverage ratio? The first one is investors because they want financial risk and stability. And the investors are two types. One is the equity investors and other is the fixed income investors or bond holders. The second party which is interested in this ratio is the lenders and creditors. Banks and financial institutions check the credit worthiness before sanctioning loans. The third party which is interested in this ratio is maybe the company management which want capital structure decision. The third party may be a regulator which want a capital adequacy requirements, and the fourth one, analyst and researcher wants the industry trend. Suppliers and trade creditors want to know the default risk and financial health of the companies, and shareholder want a risk exposure. So much thank you for your time and watching this video. Please keep this keep watching and give comments on this video. Thank you so much.